On board Laurence Balanco, technical analyst with CLSA, to talk about what his understanding of the charts is, what is overbought, what is not overbought. Laurence, good morning. Can you hear me, my friend?
I can hear you clearly, yeah.
Yep. Laurence, I look at the world, looks like there is no worry in the world. Most of the markets are either at a record high or are nearing at a record high. Crude at 100, there is a war in the world, Fed will increase rates, but equity market investors don't even have a single sweat on the brow.
Yeah, I think if you look at a lot of the headline indices across the world, particularly the Nifty and the S&P, if you take those two, for example, you peaked, for the Nifty's sake, September, October last year, and you've been in this sort of grinding trading range environment. The S&P similarly peaked December, January, and it's also been in a trading range that is roughly 12% wide, and you haven't had any real traction, both to the down and the upside. But it's the internals that I think you really show the dispersion and the performance where the concern is amongst investors. So, in the US, if you look at that unprofitable tech side, you are down 40 to 50% on some of those indices. And then on the other side of that, you've had your materials and your energy stocks trading at record highs or close to those record highs. So I think that's what's been misleading. If you just look at an index level, it's actually beneath the surface that you see where the concerns have really shown up.
Laurence, first let's understand the big picture. Do you think we are nearing the end of this bull market in global equities, or the bull market is still young, alive, and like they say, kicking?
Yeah, well, it depends on which market you're talking about. I think sort of generalizing to that extent is misleading. So developed markets, obviously led by the US, has been in a well-defined bull market since essentially the 2010. If you look at emerging markets more broadly, they've been a secular bear market since 2008. You've had these big secular swings, but you haven't broken out of any trading range. Now, within the emerging market side, India has been a clear outperformer, and you have had a trending phase there. So I think you have to be more particular at which market you're looking at to give that definition of bull and bear market. If I look at the US market, I think we are seeing a cyclical correction, which likely lasts until the midterm elections. So I wouldn't expect any major net gains for the US market until we get past the midterm elections. And then I do have another leg to the upside.
Right. Laurence, just looking at India, and it's pretty much the same picture here, wherein the benchmark Nifty is pretty close to its all-time peak. 18,000 though is turning out to be a bit of a slippery wicket, but wanted to understand from you, considering you analyze the charts pretty carefully, what both the near-term as well as the long-term charts are now indicating.
Yeah, so like I say, for me, the Nifty since September, October last year has essentially been in a trading range. Now, roughly the range that you've seen the market oscillate in is we're towards that top end of the range now, 18,000 to 18,400. And the bottom end of that range is coming through around the 15,500 area. So that's the kind of volatility that we've seen the market trading over the past 5 months. And I don't see any evidence that we're going to have an imminent and sustained break to the upside or the downside. And if anything, in the very near term, I think we're at the top of that range, being the 18,000, 18,400 area. And then there's downside risk swinging back towards your first support area, which comes through around the 17,200 area. And then below that, it's the bottom of the range at 15,500. So that's the criteria that I think we're dealing with. We're towards the top of the range, and you have now downside risk within that range.
Laurence, that's quite
the
interesting.
Longer term profile. Sorry, go ahead.
No, go ahead, please. Finish your point.
Yeah, just to finish the point, this trading range that you've seen develop since September, October, I think ultimately sets a platform for the Nifty to continue the longer term trend. And then we're looking at targets of 22 to 22,500 for the Nifty. But we've got another 2 to 3 months at least of this choppy ranging price action.
That's quite interesting. And, that's a very wide range on the upside and the downside in the near term that you just talked about, Laurence. If I were to ask you, which sectors do you see holding the markets up, and what do you think is going to drag it down? Basis on the charts, what is it that you're reading?
Yeah, so your relative outperformer, where you've seen some stability, particularly through this period that I've highlighted. So you say it's a wide range, but that's the range that we've traded in for the past 5 months. So that there's no real surprise that markets can swing to that extent over a short period of time. But within this range, your relative outperforming sector has been tech. That's been your far more stable sector. Again, we're not seeing a break to the upside, but that is a sector that is at least holding its ground and consolidating. Where we've seen breakdowns recently that can drag the market down further is coming from the auto side, as well as coming from the banks. That's where your near-term risk is. And another spot that we're starting to see the upside momentum lag and where we'll be taking profits is in your metals and mining space, where you've seen great leadership basically for the past 12 months, but that upside momentum is now starting to slow and makes it a take profit sector for us.
Laurence, good morning. Speaking of banks, about a month and a half ago, I remember you saying that the outperformance is likely to come from the banking pack, which will take the markets higher, and the outperformance will be particularly more of the public sector banks. Since then, a lot has changed. We've seen a lot of M&A activity as well, a big proposed merger as well. Do you still hold on to that view, or do you think that the leadership will now be with the private sector banks?
No, so our longer term profile is still that the Nifty Banks Index is a key component to driving the Nifty ultimately up to that 22,500 target I mentioned. If I look at the relative performance, it's the public banks that have been outperforming the private banks, and I still think that's the way to play it going forward, looking for public bank outperformance versus the private banks.
Okay, so you'll still bet on the public sector banks over the private sector banks. I thought I'll ask them to, given all of the corporate announcements that we've seen in the last couple of weeks. What about FMCG? You've been sounding, I wouldn't say bearish, but less optimistic when it comes to the FMCG pack in particular.
Yeah, I mean, unfortunately, that's a space that continues to underperform, and we see that that's a place with pharma, essentially, which has historically acted as defensive sectors, but we're not seeing that in the absolute price action of the fast-moving consumer goods sector, nor the pharma sector. So we would remain underweight those two sectors currently.
Laurence, so give me a number, and I promise you I'll make this as the big headline. You're going to get emails after this.
Fair enough.
Do you think the Sensex, before the bull market ends, could move to 100,000, which is 1 lakh? Think and answer. It's a headline I'm wanting from you.
Well, I'd say yes, but again, you haven't given me a sort of a time horizon. I think if I look at the longer term charts for India, we're clearly still in a strong bull market phase. But every bull market does have a period of cyclical consolidation, and that's what we're going through currently. So I think both Nifty and Sensex still have some way to go in their trending phases. And yes, I do think ultimately the bull market in India does take the Sensex above that 100,000 mark.
5 years, the Sensex, which is at 60,000, 59,000 to be specific, can it become 100,000? Let me define it with a time horizon and a crisper question.
Right. And the time horizon?
5 years? That's a reasonable time horizon.
I would say yes to that.
3 years?
I mean, it's absolutely possible. 3 to 5 years would be a fair time horizon for the market to reach that upside objective. I don't see anything sticking to the monthly and longer term charts while we can't reach those type of targets. Shorter than that, I think I'd be skeptical. But on a 3 to 5 year time horizon, we'd be getting up to those levels.
Headline, my friend, indeed. This is a big headline that in 3 to 5 years, the benchmark index in India, according to Laurence Balanco, could double. Okay, Laurence, my next question. What are your top 3 trades based on the current technical setup, today's setup? You would call them, these are my 3 best trades for next 3 years. And you can cut across asset classes.
So this is on a global basis,
The global level, yeah.
Yeah, okay. Well, my first one would actually come from the currency markets, and I'd flag the Australian dollar as a long trade. You've got a 4-year basing pattern in place, and I think ultimately that trades above 80 cents to confirm that base. and essentially you trade back to parity on that setup. The next trade I would look at essentially comes out of the China A-share market. This is a market that was range bound from 2015 through to 2020. You broke out of that 5-year consolidation, and price action is basically back at that breakout point. So I think you've got a good risk reward opportunity by that. So again, on that 3 to 5 year time horizon, and then you'd have to have the Nifty or Sensex, if you like, in that basket on that 3 to 5 year time horizon. So those are the 3 trades that I would flag coming out of the Asia region.
Do you think US markets have topped out, and can index or can Indian markets and other emerging markets move independently of what's happening to the US market? And let me rephrase this question just for the benefit of our viewers. Laurence, what I'm trying to understand from you is that last 10 years was dominated by US equities. An epic bull market dominated last 10 years in US stocks. Could that happen in India and other emerging markets in this decade?
Yes, is the straightforward answer. But just to put it into perspective, I can't see the scenario where the US market is falling in a significant manner and Asia, including India, gain up in absolute terms. So, we have to go to the decade looking from 2002 through to 2008. You had emerging markets really outperform like the US has for this past decade. But what you saw, the US market is essentially trading in a large cyclical trading range. So my base case on the US market is that you've got a correction into midterm elections, but you still have another leg up for their bull market that has been in place for the last 10 years. From that peak, then I would expect some kind of multi-month year consolidation in the US market, and that then should bring emerging markets to the fore again, where we can see a prolonged period of outperformance. So, where we are currently in that scenario is essentially a transitional phase where the US is seen its bull market mature, and where we're starting to see more emerging markets emerge from their cyclical bear market phases, which has essentially been a trading range since 2018, and come from that. India is already in pole position, having outperformed broader emerging markets basically over the past 3 years. So, India's leading that performance, likely to continue. But by the end of the US market, we'll probably see some fresh leadership come out of other emerging markets at that point in time.
Laurence, what you said about the trade in Australia is quite interesting. And I'm guessing that's coming in from your hypothesis on where you see the commodity cycle actually headed. Expand on that a little bit.
Yeah, so we've done some work on the longer term charts of commodities. And just to put the duration of commodity bull and bear phases into perspective, we've got a nominal chart of commodities going back 100 years. And basically, when you look at the 10-year return of commodities, every 30 years, you see this accelerated performance in commodities. So that basically every 30 years, you get a major commodity cycle peak. The last one was 2008. What typically follows that is a 10-year bear market, which we think bottomed out between 2016 and 2018. And then from there, you've had this trading range, which we broke out earlier this year. The bull market extent is typically a 10-year affair. So we can see, while we will have pauses and corrections in commodities going forward, the trend for commodities is to have higher commodities basically into the late 2020s on the current trend. In the very near term, yeah, we do have some extended commodities and would expect some consolidations, but the longer term trend on a multi-year basis is for high commodity prices.
I hope when you say commodities, it excludes oil, right? Or do you see oil as well to be as elevated as metals?
Well, I think, if I look at the oil price, yes, it will be at an elevated level. Currently we're looking at $93 to $90 being the floor, and we've got a ceiling of resistance currently around the 125 to 127 area. So on average, we would expect higher oil prices, but where we get the most constructive charts are really coming through from the base metals, but also the agricultural commodities. So that obviously does carry some inflationary inputs into markets at the end of the day.
As that happens, that's crude oil. There's a lot of volatility and price action that we're also seeing in metals. And Laurence, you were just talking about that, and you answered one of Aisha's questions, as saying that that could also be a pocket of growth.
Yeah, absolutely. I mean, I think the one standout commodity that I'd look at currently is actually copper. It's lagged the other base metals. It's got a great 12-month consolidation. If I look at the CMX copper futures, and we're looking for a break above the 490 area, and we've got minimum upside targets of 550 to 580. So I think copper has lagged, but the chart structure is constructive. That consolidation pattern that we've seen over the past 12 months sets a platform for a re-rating in copper. So to me, that's the current standout in commodities, is copper playing catch up with the other breakouts that we've seen across the base metals.
Okay, so copper is what's standing out for you when it comes to base metals. I'd like to just elaborate on a point that Nikunj was raising with you. We've seen the equity markets in India make a comeback, and a decently strong comeback. Even the broader markets are doing a lot better. We had seen the foreign institutional investors really press the sell button. They've also started to make a comeback. Can you share with us the kind of advice that you guys are giving to the foreign investors, the sentiment change that you are seeing on ground as far as India goes?
Look, I mean, from the conversation with clients that we've had, that they've been well positioned in India for some time, and obviously benefited for the performance that you've seen coming through from the Indian market. We have seen for our broader emerging markets investors that there has been some profit taking in India and rotation into Indonesia. And we've also seen some rotation into Brazil with obviously the commodity move that you've seen there. So, you know, after India essentially being the only real play in the region from the 2020 lows and a key driver on the upside, there is a bit more competition and rotation going on within the emerging market sphere. But India remains a core holding in the investor's portfolio, but we are seeing some rotation and profit taking out of India. And that has been shared across the region. Indonesia's benefited, but we've also seen money going to Brazil on the commodity trade. So it hasn't been significant outflows, but it has essentially just been remanaging the overweight and the performance that they've seen from India over the past 18 months.
So, Laurence, for rest of this year, first half has been a volatile year for just about every major asset class. Do you think the second half will also be choppy and volatile, or we could get a clear trend?
I think we get a clear trend post the midterm elections, and I think unfortunately into the midterm elections. So we're basically talking this quarter and the third quarter of the volatility that we've seen in the first quarter continue. So I think, investors have to be patient. We sort of summed it up in baseball terminology, is that you're basically looking for singles currently and not for home runs. But we think into the fourth quarter and the start of 2023, we'll start to get better trends and clearer trends developing. But until then, we think the choppy, volatile nature of markets will remain intact.
To Laurence Balanco, if I say that he feels that if you're an investor, you should not get bothered because of the recent volatility, and one should not be in a hurry to sell stocks or go short. Will I be summarizing the interview just correctly then?
Again, it depends on your time horizon. I think the volatility does create opportunities for both the long and the short side. I would sum it up, if you're not inclined to play short-term tactical trades, the less you do, you'll see less damage from the whipsaw nature of the volatile markets. So again, your time horizon is obviously key. If you're a longer-term investor, I think sitting out the volatility and not trying to trade that would probably stand you in good stead on the longer term side. But for shorter term traders, I think there are opportunities both on the long and the short side to benefit from this volatility. The point is not to oversize the positions in those tactical trades.
Laurence, such a great pleasure to have you today on the show, and speak so candidly across asset classes and across geographies. Good having you on the show.
Perfect. Thank you.